Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. Ladies and gentlemen, this should be an interesting episode because, frankly, I'm going to be criticizing most of these businesses. If you have these companies in your portfolio, don't take offense to it. Try to maybe think through your thesis and go through the reasons why you might want to continue owning this business, or perhaps I might be able to change your mind on some of these companies. So we'll see. It should be interesting. With that being said, in today's video, we're going to go over 7 different companies that I've sold in the past, give or take, year or two. These companies were in my portfolio at one point, so that should probably tell you whether or not these are quality businesses. Starting us off, we have Paycom Software, which I actually sold very recently. I sold it 14 days ago. If you guys follow me over on Twitter, I update you guys on my portfolio and what I'm buying and selling all the time. And so Paycom was a company that I sold 14 days ago. I've made previous videos talking about how much I love the company and all that type of stuff. But recently I sold it, and I have a very good and valid reason as to why I sold it. Now, many of you guys know my investment philosophy is to just try to maximize all the money I have. Like I really don't try to keep spare cash lying around. Sometimes bites me in the back, but at the same time, like, I don't want to have the stress of like, oh, the market's running up, I have 5% cash deployed at a valuation that I'm a little bit desperate for, and FOMO and all that type. It just works best for me that as soon as I get paid and as soon as I get cash ready for the portfolio, within a week or two, I've invested it in the best opportunity I see at the time. For me personally, in my own investor psyche, that's what has worked well for me. But in some cases, it does lead to making decisions like this where I have to cut Paycom at a 7% allocation because I have Google and I have the opportunity cost of Google at a cheaper valuation, wider moat, and faster growing, right? And to be honest with you, I don't mind doing that. Of course, there's the reputational aspect of it, especially because I'm publicly showing my portfolio nowadays. But at the same time, I don't mind it. With that being said, why did I specifically sell Paycom? I have one problem with Paycom, and that is the fact that it's not what I like to call a mega moat business. If you look through my portfolio, every single one of these businesses are incredible businesses. They're very wide moat businesses. In the case of something like Amazon, like, with AWS, GCP's for Google. AWS, obviously the core e-commerce business, like the amount of capital expenditures that Amazon has put forth in the past 2 decades, nobody's ever going to catch them. Salesforce, I've done an hour-long deep dive into that business and why it has just probably one of the widest moats in all of software, not going to get disrupted anytime soon. I'm looking at you Palantir people. Google, the business I recently just bought, the search moat, all that type of stuff. Again, I just did a video on that. It's an incredible business. I'm sure I don't have to sell you on that. MasterCard, some of you are very familiar with, others maybe not so in tune with what exactly MasterCard does. It's the true toll booth and middleman service between you trying to pay for goods and the business that is accepting the payments. I like to call it as a tax on all commerce. They literally charge 2-3%. That is the merchant discount rate. They don't actually keep the 2-3%, but they keep a smaller portion of the 2-3%, MasterCard and Visa, on all global payments, essentially. And it's like a 5-sided network effect. It's just a brilliant business. They don't issue any credit. They don't bear any balance sheet risk. I think it honestly might be the widest moat in the world. And then the tiny little business ASML, I say tiny, and yet it's like a 300-something billion dollar market cap business. They make the machines that Taiwan Semiconductor Manufacturing, Samsung, and Intel, the big foundry businesses, they make the machines that those foundries end up using to print the NVIDIA chips, the AMD chips, Apple's M chips, all that type of stuff. So they make the machines that print the chips. You know what I mean? So very wide moat business, and they have the technological leadership on that front. So again, as you can see, the 5 holdings I have in my portfolio, these are all mega moat businesses in their own right. They have incredibly well defended positions in the market, and in some cases, they are the sole provider or in an oligopoly with other similar companies. And Paycom, frankly, was just a sore outlier in the portfolio. It did not meet most of those qualities. It's in an incredibly crowded HCM market. Doesn't mean it's not going to do well in the future. It very well could, but it was in a very crowded market with much bigger players. It was not a leader in the industry, and admittedly, it was taking market share, but at the same time, like, quality-wise, it just didn't meet the portfolio. And you might have noticed the name of the channel is Quality Investing with Arya. We invest in quality here. And it was one that always bothered me, even going back a couple months in portfolio updates. It was one that, I don't know, I was a little bit hesitant on. Anyways, great business. Like 3-4 of my friends that I talk very closely with, they're all invested in it. I hope it'll do well in the future. So just wanted to clear that up. That's the first one out of the way. And then one last thing, just because I know a lot of you might comment about it. Paycom's trading at a 20 trailing PE. GAAP trailing PE, but it's a little bit misleading. That is because if you look at the stock-based compensation that this company has issued, you might notice there's a little bit of an outlier in the March quarter. And so the CEO of the company, he gave up a lot of I think the options that he was due or something like that. Like he gave up some of his compensation because they got a co-founder very briefly and all that type of stuff. Anyways, by GAAP net income rules, what you have to do is you have to record that as a negative stock-based compensation event, essentially. And so if you adjust for this, you end up with roughly $6 of earnings per share. And so with roughly $6, or even let's just give them the benefit of the doubt, $6.50 of earnings per share, you will end up with give or take a 25 to 27, 28-ish trailing PE. Google currently is trading at like a 21, 22 trailing PE, right? Or even at where I was buying it, was trading at like a 21 and a half trailing PE. So it was just frankly a no-brainer, right? You have a cheaper business multiple-wise for most definitely a wider moat, faster growth, and actually not a better margin profile. I think Paycom would beat it out there in terms of margin profile. Moving on here, I don't want to spend too much time on Paycom. You might not know this, but actually, I used to own Vici Properties. Now, I own this very briefly, but in the duration of time where I did own it, I kind of realized, I'm like, why do I own a real estate company, like a REIT? Why do I own a REIT? I don't understand. I'm very young. Like I don't need the income, and frankly, my portfolio at the time and even today is at nowhere near the point where the amount of yield that I'm getting from this investment, nowhere near it's big enough for me to even like benefit off of it in any way for me to pay any type of bills or anything like that. My portfolio at the time was multiples smaller, but I mean, even today, if I were to make it like a 5% position, it wouldn't be meaningful. Number 5, Visa. So I do own MasterCard today, but for a little while, I didn't like Visa or MasterCard, and my argument against it was they just grow too slowly. And then I realized that MasterCard actually grows in like the high teens, which I'm not sure where I got the notion at what point that they were both like very similar in terms of growth profile, this and that, whatever. But for Visa, that is the case, and we could pull this up on FinChat. If we simply look at the trailing EPS growth for the past 5 and 10 years, on the 10-year it looks better, but it seems that it has deaccelerated down to roughly 12%. And it seems like analysts on a forward basis expect roughly similar amounts of growth, roughly in the 12 to 13% range. Honestly, EPS-wise, pretty good, but I do remember that on a free cash flow basis, it was growing like a little bit slower. I think it was in the 11% range. So free cash flow per share should be also around like 12, 13-ish%. Now on the flip side, if you go and look over to MasterCard, MasterCard's growing earnings per share on both on a trailing 5 and 10 year, roughly between 15 to 17%. And then on a forward 2 and 5 year basis, analysts are expecting roughly 16% earnings per share growth, and this is in line with free cash flow as well. So free cash flow is just core free cash flow, not per share, is expected to grow at 16%. So I think actually on a per share basis, you're looking at like 18.5% free cash flow per share growth for MasterCard. So that's why I personally prefer MasterCard over Visa, and especially at the time that I was buying it, on a valuation to growth perspective, MasterCard was slightly cheaper than Visa. Now, of course, there's always the argument of like, oh, you know, the margins, this and that, whatever. If anything, I would prefer to have the business with the slightly lower margins because it leaves more room for margin expansion in the future, which would translate to more bottom line growth. But some people point to the margins as a reason why it's the better business. Frankly, at the end of the day, they both have the same or similar margins. So it doesn't really matter too much. Anyways, I sold Visa for a lack of growth at the time. Again, relatively small position at the time. Ulta Beauty. This is a fun one. So I did actually own this at one point, and it was a very small holding, and I took some nice profits on it. I did ride this up to like, I don't know, it was like 570, 580 or something like that, like pretty close to, maybe not too close to 600 a share, but I don't know. I think it dropped based off the news that like the CEO said that, you know, the retail was slowing, this and that, some type of news like that. And honestly, I was just looking at it and I'm thinking to myself, why do I own a business that's growing like 3, 4, or 5% revenue growth per year? I could just buy it again. Like I'm really going through the growth is way more important. Like I think in spring of this year, like everything kind of hit me all at once, and I'm thinking, oh, why I'm so young. Why would I own something that grows so slowly? And so I started dumping some of these slower growing businesses that aren't as moody. So I think it says number 3 here, but I think we might be on our fourth stock here. So LVMH, Louis Vuitton, which is the parent company of a lot of companies actually. I mean they have Louis Vuitton, Dior, Sephora, the retailer, a bunch of other companies I'm blanking on here, but they have a lot of brands. They have like 75 different brands. They own some alcohol brands like Don Perignon and all that type of stuff. It's a phenomenal business. It's a massive conglomerate. It's like the 15th biggest company in the world, something like that. I listened to the Acquired episode where they talked about the business, and I was just so blown away by how brilliant of a business model it is and how great of a CEO Bernard Arnault is, that I started digging into it a little bit more, and then I ended up making a purchase decision with that. Now, qualitatively, meets all my criteria, no question about that. Like, I just absolutely love the business. I love the history. I love how long these brands have existed for, all that type of stuff. It's like zero complaints there. One problem. Again, similar to Ulta, it's not growing too fast. Realistically, it's gotten to a point where they have two options to pull in terms of growth levers. They can either say, screw it, we're going to just cut the marketing budget, because they spend like, I think like $40 billion per year in marketing. This is an $80 billion revenue business. So half of the revenue, guys, we're not talking like net income, operating margins, nothing, guys. We're talking half of the revenue is going towards marketing, which is just truly ridiculous, right? So they have two methods of growing the bottom line in the future. One, we're going to cut that marketing budget, which that would kind of work counterintuitive to what built the moat, which is dump so much money into marketing and advertising that you just ingrain yourself into the average passerby's mind that this is a luxury brand, and you remind them of the existence of the brand. That's the strategy with the business, right? So that's an unlikely outcome. The likely outcome, which they've done in the past 15 years, is, hey, we have this core cash cow business in the, let's just call it Louis Vuitton and whatever, that's growing pretty slow, whatever. Let's just buy a bunch of new up-and-coming makeup brands. Let's buy a bunch of new, like Sephora, the retailer that's growing at like 20%, 25% revenue. Let's buy these businesses, screw the multiple, and actually there's a wonderful story with one of these European jacket brands. I'm blanking on the name, and this is bothering me so much. They bought it for like 40 times sales or something just outrageous. And then in the span of like 3 decades, it was an incredibly worthwhile investment, because once you're able to input, you could overpay on a brand, and once you're able to input it into the massive conglomerate that is Louis Vuitton, you're able to gain so much negotiating power. For example, if you're advertising at the Super Bowl, hey, did you want the Dior only advertising rate, or did you want the LVMH conglomerate? So you gain a massive amount of bargaining power simply by being correlated with LVMH, just because if you're the Super Bowl and you open the door to advertising for one of the brands, all of a sudden you could gain advertising dollars for all the brands. And so you might give them a favorable rate compared to another conglomerate or another brand. Moving on, PayPal. Bit of a controversial one, but this has worked out wonderfully. I sold it on March 4th, and I bought a solid amount of Google with it. Those shares of Google I've held since. As of today's recording, PayPal shares are trading at roughly $70 a share. That translates to a roughly 17% gain. And at the same time, Google has also gained about 17%, which is actually just quite lucky. But anyways, it's also gained about 17% since that day. And the important thing to note, though, is that Google, as of recent, was at a significantly higher price, and frankly I think it's quite oversold at the moment. That's why I've been buying a lot of the stock recently. I think it's quite undervalued, and I think in the long term, of course it's only been, I don't know, give or take like 6 months that I sold out of PayPal for Google, but I think in the very long term, if we zoom out, there's a great chance that Google is going to outperform PayPal. Moving it a little bit further here, and this is the main stock on the thumbnail, I saved the best for last, Tesla. So this was the initial axing of my old portfolio, and just completely switching strategies. I think in the past year, I've probably had like close to 100% portfolio turnover. I think the only thing that I haven't sold from the old portfolio until now is Amazon. I've never sold a share of Amazon, but as a part of my old portfolio, I did have some Tesla. Now, I'm going to get ahead of this and say this. I did gamble on the earnings a bunch of times, and on my brokerage, it shows like your net realized gain or net realized loss. Net with Tesla, I'm actually at a realized gain. So before any of you say I'm a salty bag holder, salty about losing money, all that type of stuff, net everything, I've made money on this stock. So just to clear that up. With that being said, I sold Tesla, and I could not have timed this better. I sold the bulk of my shares at $262 per share. Now, I don't know if you know, but Tesla peaked last year at $262 a share. And I sold it, I remember, because it had gapped up like, I don't know, 4 or 5% that day. And I had wanted to sell it for a while, right? But I was just getting greedy, this and that, whatever the case was. And I remember I was actually at work, and I got the Yahoo Finance notification, and I sold it at like, give or take 10 a.m. or something like that, 9:50 a.m. So I sold it in the morning volatility. I'm like, you know what? I don't care if we close the day 8-9% up, whatever the case is. I don't care. I'm getting out. And the stock is down since. So I guess it's been a pretty decent sell. And I think that money made its way into Amazon. I want to say it was pre-earnings, so it must have been in like the 155-ish range, give or take. So net everything so far in the past, call it 9 months or so, it seems like that was a pretty good trade as well. Now, the problem I had with Tesla was I had initially bought on the thesis of a stupid thesis, unlimited demand, and they have a bunch of different avenues of revenue growth, and FSD was probably the biggest selling point for me personally. I thought they were going to release a subscription and a bunch of people were going to get FSD and all that type of stuff. Everything slowly fell apart. Oh, another core component of my thesis was the gross margin story. I thought that Tesla, being at the time it had like 26-30% gross margins, the fact that they had that differentiated them and showed the fact that they were able to make cars at a more profitable price point where people are willing to pay a premium for their products. They're going to make essentially what the iPhone is for hardware makers and phone makers. Instead, they're going to make it with cars. They're going to make a luxury car that people are willing to pay up for because it's better technology, sleeker, smoother. You're just gaining a better experience, and you have the brand name there. So all those things, I actually compared it to Apple in a lot of cases. And I was saying, oh, they'll sell hardwares. Sure, it might be cyclical, but in the future, they'll be able to kind of bring in this services segment, and they'll be able to bring in FSD and all that type of stuff. And that will compensate for the fact that this is hardware at the end of the day. These are cars you're selling. Car industry is not a good industry. That'll compensate for that. And of course, there was always the speculation of the Tesla insurance and the internet service that's going to go and all that type of stuff. So at the end of the day, it was a subscription story that didn't play out. That was my problem. The gross margins did not play out. The demand, the infinite demand that we were sold on, did not come through. And then Elon, the cherry on top was Elon Musk, that would just repeatedly lie and put out outrageous claims and be in a headline every other day and causing some problems, selling some shares, doing this. He's buying Twitter. He's neglecting Tesla. Reportedly, he hasn't showed up to a meeting in 10 days. Just too much drama. Now, compare that with putting your money into MasterCard. I don't think MasterCard has been in a Wall Street Journal article in the past 2 years. It's probably been, but you get my point. Like, MasterCard is just working in the background and just keep compounding, going up into the right every single quarter without fail. People are spending money, right? Like, how much simpler of a business is it to own? And then all of this is happening while the revenue growth of Tesla, which is what we've been sold on, has been faltering. It's been slowing and dropping. And so I sold at this point. I sold in Q4 of 2023. At that point, they had actually had pretty good revenue growth up until that point. It's really fallen apart in the past 2 quarters that Tesla reported. In the past 2 quarters that Tesla reported, it halved and then swung into the negative. It has been a disastrous fundamental story, at least on the automotive revenue side of things. The energy business, it just doubled quarter over quarter, which is honestly remarkable. I'm very impressed with that. But the automotive side of Tesla is no longer in hypergrowth. And of course, this is part of the business. This is cars. This is hardware. There's cyclicality to these things. And yes, there's a world where in the future, Tesla comes back and just knocks it out the park, and I'm incredibly wrong, and it goes to 10 trillion, and they go to Mars, and they do deep space metal mining, and it equals global GDP, the market cap. That's a very possible case. I'm willing to have my money invested elsewhere where there isn't as many complexities, and I'm not invested in a business that's trading at 150 times earnings per share. So far, it's been a pretty good sell. If you own it today, I highly recommend you go over your own thesis and objectively ask yourself, is it on track? Am I holding on to this simply because I'm down on it and I'm not willing to lose money. Seriously start to ask yourself these questions and ask yourself, would it be simpler if I just put my money elsewhere? Maybe even call it quits, go passive investing. It's very easy, guys. Just put your money in like a growth ETF, not financial advice, of course, but just put your money in like a growth ETF and you should be able to outperform the S&P 500 simply based off that. I like to invest in the SCHG whenever I don't have good ideas for individual picks, but you're more than welcome to QQQ, of course, is very popular ETF, all that type of stuff. With that being said, we've been using FinChat charts the entirety of this video. If you're interested to try it, you get 2 weeks for free if you use the link in my description. There's no obligations in terms of payments or anything like that. Completely for free. Just literally click the link, sign up with your email, and you're going to be able to try it out completely for free. You should also hit the subscribe button while you're down there if you like the fact that I don't waste your time. Thank you for watching and have a great day.